Welcome to the deep dive. Today we're tackling a bit of a paradox, one that you see all the time in crypto, which is this idea that, short-term pain is actually setting the stage for long-term gain.
That's exactly it. And the data right now is really telling that story. We've been looking at analysis on Bitcoin, and it's going through one of its worst Novembers since 2019.
Yeah, the numbers look pretty rough on the surface.
They do, but if you look just a little bit deeper, the analysts are almost all saying the same thing. This isn't a panic moment. It's more of a structural reset, a foundation for a really strong 2026.
Okay, so that's our mission for this deep dive. We're going to give you the shortcut to understanding that. We need to figure out why a month that has seen Bitcoin fall almost 17% is being called an opportunity by, the smart money.
Right.
We'll walk through the historical numbers, what analysts mean by market cleanup, and I think most importantly, how this huge wave of institutional money might finally be breaking that four-year cycle everyone thought was set in stone.
It's a really fascinating mix of old patterns meeting new money. The speed of it all is the real story here. So, where should we start? Let's look at just how rough this November has been.
Yeah, let's get that reality check out of the way first. As of today, Bitcoin is hovering around $91,500. And it's down, about 16.9% for the month? For anyone used to those end-of-year rallies, that is a tough pill to swallow. It puts us on track for the worst November since 2019.
And that historical context is so important for you to get the weight of this. November is usually a really strong month for Bitcoin. It often kicks off that big holiday rally.
Right.
So when you see a dip like this, it's pretty unusual. Back in November 2019, the market lost almost 17.3%. So we're right in that same ballpark.
But it's not the absolute worst we've ever seen.
No, not even close. For that, you have to go back to the really deep bear market after the 2017 peak. The absolute worst November on record was 2018. Bitcoin dumped a staggering 36.5% then.
Wow. Okay, that's a different level of pain.
It is. More recently, 2022 was also tough, shaving off about 16.2%. So where we are now, it's right between the bad years and the truly terrible ones.
And what's interesting, is the pattern that seems to come with it. I saw the crypto educator Sumit Kapoor pointed this out.
Yeah, that's a key piece of the puzzle.
He said November is normally one of Bitcoin's strongest months, but here's the kicker. He says every single time Bitcoin has had a red November, December has also ended red.
Every single time. It's a perfect historical correlation so far.
That feels like a really serious indicator then. If history is any guide, we should be bracing for a red December. So that brings up the big question, right? If the precedent is so clear, why aren't analysts panicking?
That's it. That's where the story shifts from just looking at the price to looking at the market structure. They think the pain is actually the medicine.
Okay, I like that. Let's unpack that idea of pain as medicine. We keep hearing this term capitulation. Can you just, define that for us?
Absolutely. So when analysts talk about capitulation, they mean that that final painful moment in a downturn where all the less committed sellers just give up.
The people who are over-leveraged or just bought the hype.
Exactly. They're forced to sell because they just can't take the losses anymore. The LVRG research director, Nick Ruck, he points out that this current capitulation, while it hurts, is an opportunity for smart investors to start buying back in.
So the market hits peak pessimism, and that's the signal to move forward. But why is it happening now? What is this downturn actually cleaning out?
It's all about systemic health.
Yeah.
The market just needed a reset. There were too many short-term speculators, too many projects leveraged to the hilt, especially in that run-up to the ETFs earlier this year.
Right.
Nick Ruck puts it very clearly. He says, over-leveraged participants and unsustainable projects have been largely cleared out.
Okay, that feels a little abstract. Let's make it stick with that metaphor we were talking about.
Yeah, let's do it. Think of this market flushing as like draining an old stagnant pond. An old pond that hasn't been looked after. It's full of murky water, sludge at the bottom. That's all the over-speculative money, the margin traders, the weak projects that only really survive when everything is going up.
The shallow-rooted plants.
Exactly. They look great in the sun, but they can't handle the first frost. This painful drop, the 17%, that's the process of draining that pond. It's not pleasant. It might smell for a bit. But once that murky water is gone, you've prepared the ground. You've made room for new, clean investment to flow in. And more importantly, it lets the long-term patient holders, who are the real foundation of the asset, it lets them scale in ahead of a promising new year.
So 2026.
meaning 2026. The painful removal of the weak hands is what actually strengthens the structure for the next bull run.
That makes the short-term pain sound
Yeah.
a lot more strategic, I guess.
Right.
So November's pain is just the market shifting gears from speculators to long-term holders. But that brings us right to the elephant in the room, institutional money. What does this all mean for that traditional 4-year cycle?
It means that cycle is facing its biggest test ever. I mean, for more than a decade, Bitcoin investors have navigated this, somewhat predictable 4-year cycle.
Right. The halving, the peak a year later, the bear market. Green candles in October, November, December.
You could almost set your watch by it, but that predictable rhythm is completely changing, and it started earlier than a lot of people expected.
And the trigger was the ETFs, right?
It was. Justin and Ethan over at Arctic Digital, he argues that the whole cycle got kicked off early because of that one huge event, the launch of the spot Bitcoin ETFs in the US back in early 2024.
But how does a financial product, even a big one, totally disrupt a pattern that's held up for so long?
This is where that analogy comes in handy.
Yeah.
Think about the old 4-year cycle, driven mostly by retail psychology and the halvings. Think of it like a predictable commuter train schedule.
Okay, I'm with you.
Everyone in the city knows when the train arrives, where it stops, its final destination. It's reliable.
That was the old cycle.
Exactly. Now, the arrival of institutions in a meaningful way, through the ETFs, that's like suddenly building a major new subway line that changes the entire city's traffic pattern overnight.
Ah, okay. That's a great way to put it.
The destination, the long-term upward price of Bitcoin, is still the same, but the pace, breadth, and timing of the whole journey are now fundamentally different. Institutional money brings this consistent, passive demand that doesn't really care about the monthly closing candle. It cares about asset allocation over years.
That's that classic, this time is different line that always makes people nervous in the markets.
It is, but Denethan sees it as a positive. He's suggesting the market is finally maturing, becoming deeper, less reliant on that volatile retail feeling.
But that raises a tough question, doesn't it? If this institutional capital is so consistent, why did we just see a massive 17% drop? Doesn't that look like institutional support failed? Or maybe that the old retail cycles are still in charge?
That's a great challenge. And the thinking is that even with institutional support, the market still had to clear out the existing leverage that built up before the ETF wave really got going. This dip might just be the market correcting its own overenthusiasm from late last year. It's the messy transition period where the old and new cycles are colliding.
So the key is where the price lands after the collision.
Precisely. And as we head into the last few days of the month, technical analysts are laser-focused on where that monthly closing candle lands. That final price is crucial for keeping the long-term uptrend alive.
So let's get specific for our listener. What are the key price levels, the technical barriers we have to hold for all this optimism to stay justified?
There are two main levels everyone's watching. The first and most important right now is around $93,000. Then there's the much bigger target of $102,000.
Okay, so why is that $93,000 mark so critical right now?
It really defines the immediate health of the uptrend. A monthly close above 93,000 is pretty much seen as the minimum requirement for a successful, end to this painful month.
And why that specific number?
Because closing above 93K would maintain what's called a higher low on the chart.
And in plain English, a higher low means?
It just means that even after this big dip, the lowest point we hit is still higher than the lowest point we hit during the last major correction.
Got it. So as long as the new bottom is higher than the old bottom, the overall trend is still up.
You've got it. It's the fundamental rule for keeping a multi-year uptrend intact. And most analysts think closing above that 93,000 mark is still highly probable.
Okay, so that's the survival level. What about the $102,000 level?
That's the aspiration level. A close above 102,000 would be incredibly bullish. It would mean the market just completely shook off all the November selling pressure and is ready to run.
But that seems less likely for this month.
Yeah, the analysts think we might have to wait until next month for that. But it's the signal for true accelerated momentum heading into 2026.
And with BTC trading just under 92,000 right now, it's definitely going to be a tight race to the finish line. Those levels are the litmus test.
Indeed. It's the difference between just surviving the month with the trend intact versus setting a really robust foundation that actively defies that old historical pattern.
This has been a really fascinating deep dive. So to summarize for everyone listening, Despite a historically painful red November, analysts see this as necessary market hygiene. We've drained the stagnant pond.
Right. Gotten rid of the leverage and speculation.
And critically, institutional involvement through the ETFs is changing the game. It's turning that predictable old commuter train into a whole new subway line, setting the stage for strong long-term growth, probably for 2026.
And that leaves us with one last provocative thought for you to chew on. Given that a red November has always meant a red December, does the arrival of all this institutional capital and the need to hold that $93,000 floor, does that finally break the old pattern? Or is December 2025 destined for another pullback before the big push in 2026?
That's a compelling question to end on. If you enjoyed this analysis and it helped you connect the dots between the short-term pain and the long-term story, be sure to follow, like, and share this deep dive.
And if you want to keep up with more insights from the space, you can follow What Bitcoin Taught Me on Twitter, X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks for joining us.